we have Aarti Industries, and buy rating is given for Aarti Industries, and fair value of 1000 not 80, an upside of 17% from the current market. Now, what are the rationals? The rationale that is used are it is a scalable chemical company, and now post sharp trajectory along with ROC improvement. So ROC will be improved. So this is the reason why the stock price will peak, and there is a expectation for earnings to go by 26% and 43% in FY 2022 and for FY 23 respectively, and the discounted cash flow is done, and with that we have arrived the fair value. So this is the fair value, and the period of holding is 12 months. And what are the positives about this company is that presence across basic to specialty chemicals and large addressable market, and cost efficiency, supply chain independent to India, and favorable macro conditions despite depreciation of INR versus RMB, and import substitution, and China plus one support of all growth, and the turnover will improve by 180 base points for ROC improvements over FY 21 to 24. The key risk is that the economic slowdown and raw material inflation. And secondly, for Hindustan Unilever, so this is the short form HUVR. Ad rating is given. When ad rating is given, that -5 to +5 is the expectation of return. So this is the target price, and this is the current market price, and we expect 9.2% returns. And why this stock will go up is because they are turning to premiumization and for market development, and the management is expecting consistent double digit earnings growth. Yeah, that's great. Then we expect earnings to grow by 14%. If it is 14%, then will it be a double digit return? Maybe possible in FY 22 estimate, and grew by 21.5 in FY 23 estimate. So the stock is currently trading at 57 p. Oh my god, 57 p. That's so expensive, but the market is ready to give such a high p because their management is good. So this is expectable, and it is done by discounted cash flow method. And what are the positives about this company is there are significant headroom for growth in FMCG consumption, and this company has been going for premium beauty business and focusing on first digital first brand, and this company has been dominant in the market for premium laundry segment also, and expect double digit growth in nutritional portfolio. Okay, and what are the negatives? The negatives are it is facing if it faces raw material inflation for three fronts, and it may lose some talent to startups and e-commerce platform. So there is a possibility that their talented employees would join some startups or e-commerce platforms. So this is the threat for it. And if we go for LIC Housing Finance, buy rating is given, and uh, we have an update, and the target price is given is 600. So we see a 40.5% upside. My god, 40.5% upside. I don't know if this is achievable. An improvement in real estate cycle. So I was talking about the real estate cycle, that driving high disbursement and Agio well. So helping them in the disbursement, and so rise in ECL coverage, and also for capital insurance, it is providing comfort. So we raise the estimate to reflect capital insurance and higher NIMS. So we raise the face value to 600 from previous 575 and upgrade it to buy from add. Okay. So about the company update is that the capital insurance of 2340 crore will reduce the risk of hitting the regulatory cap, and also reduce the risk of downgrading, and market sources suggest that strong retail home disbursement is that the loan growth will also grow by quarter 2 FY 2022 estimate. So by quarter 2, the loan growth will also grow, and the non-core loan growth for negatives. Non-core loan growth is expected to remain muted, and we alleviate credit cost over the few quarters. Let's go to the next one. We have Aluminium, National Aluminium, NACL, and here the type of report that we have received is result update. The current market price is 93 and target of 100 is given, and 7.5 upside to this at a fair value of 100. And the rationales that we have used is that it is going to benefit from a strong aluminum prices with multi-year deficit, and NACL pure play in aluminum and alumina commodity. So a strong operating earnings would fund the capex, and positive FCF despite growth capex would help NACL sustain approximate 5% dividend yield. So buy rating is given at the value of 4.5 times of September 23 estimate of EV upon EBITDA. EV upon EBITDA is enterprise value upon earnings before tax and depreciation. So for that we get that fair value of 100. And about the company updates, for positive updates, spot aluminum prices are 7% higher than quarter 1 FY of the average prices. An increase in NACL EBITDA by 15% divided by 30% for FY 22 to 23 estimate. We factor high commodity prices, so there is a possibility that prices will still strike up, and aluminum prices are expected to increase with the ongoing cost pressure. I don't know how long this pressure will last, whether this pressure will decrease the prices also. NACL has undertaken 10 lakh tons aluminum refinery project, and we see as a return dilutive. And return dilutive, why it is said like that is that this the project can be a failure also, no? So this is the thing. Then we have PVR. So for PVR, and again company update at this price, and this is the target price, and fair value of 1700 and 6.3% upside. And about the rationals is that we expect PVR business to recover in second fiscal year 2022. So it will be better if we buy and hold now only, because this is quarter 2 FY 2022. So presently we are in quarter 2 FY 2022. So by the time we reach there, the price will strike up. So it's better we buy and hold. So and also the room for re-rating and operating metrics have also recovered fundamentals of business broadly intact, as we would keep one eye on the risk. PVR is surely risky because of the situation of COVID, and we expect EPS to grow by 70.3 by FY22 and 239. Oh my god, 239 EPS growth by FY23. I don't know if this is achievable. We expect PVR for 12.5 times September 3 EV upon EBITDA, and for that we get a fair value of 1700. Let's go for the positives of the company, and we expect government to lift ease COVID restrictions in the absence of the third wave, and permanent downward reset in cost structure to the tune of 10% of employees and other fixed costs. And then the capex intensity and competitiveness intensity can potentially be moderate. It will not pick up. They say that it will remain moderate. And the negatives is that the Maharashtra government is yet to opening of the cinemas. They have not even received the approval. We expect PVR to report negative free cash flow of 424 by FY22. This company will surely have a negative cash flow. There is a possibility now for TCS. Add is even. When add is even, at minus 5 to 5%, we must keep the expectation. Target price is 4,200, and this implies a upside of 11% towards the current market price. And for the rationales why we must buy is that the business momentum is reasonably strong. TCS will have a long runway. TCS is performing little bit slow as compared to other IT industries, and low attribution is competitive advantage in supply constrained environment. We expect earnings to grow by 19% in FY22 estimate and 14% in FY23 estimate. So the value of the stocks will be 32 times, raising the earnings estimate and the fair value that we have received. For that only add rating can be given. And what are the positives about this company is that TCS is a very old company and highest return on invested capital, ROIC, among the peers. TCS is a key beneficiary of large shift from transformation deals. Transformation can be for 3 to 5 year journey from organization. TCS also enjoys a low level of attribution compared to peers. It can sustain approximate 26% EBITDA. And for the negatives is that TCS attribution is to be lower than the peers. It can increase above pre-COVID level. Thank you.